That is what he was telling me. While we were waiting, he was waiting for his turn on air. He was saying he sees a lot of risks.
Yeah.
Rohit, you want to explain?
Yeah, you see, we've seen a pretty good rally in the markets since the elections happened. And I think ever since the Modi rally started, my sense was always that, whether that this might not be a sustainable run beyond a point. We've seen a good run. And since June, July, we are trying to set higher targets, maybe that the Nifty goes up to 8,400. But when we look at it in hindsight, after July, we started seeing stocks give up pretty strongly. And therefore, those targets are not getting achieved. And you're getting a lot of volatility in the index itself. At the same time, two global factors that are strongly coming into play. One of them is that the dollar has started to go up pretty strongly. You have a strong dollar rally happening in the world market. And the second one is a risk which is still not become very big, but is a risk for the next 6 to 12 months, and that is rising interest rates at a world level. So all these factors put together, you're looking at a market which has had quite a good run. It's fairly valued, and money is already moving out of most of the cyclicals that it ran into. And then again trying to get back into the defensive or rather globally exposed names. I wouldn't say they are defensive, but most of them are globally exposed, whether you look at technology, auto, pharma, all of them are being bought into for their global exposure. So essentially the bet therefore is on global markets. It's not really on the domestic market anymore. Most domestic cyclicals, banking stocks are on their way down rather than up, and the index is holding up essentially on the back of a handful or a narrow list of stocks. Can that continue? Yes, but a lot of what we are seeing now, when we look at it in hindsight, a lot of the last 3 months mimics what we saw in the last quarter of 2007, and that's a little scary. So if this market has to continue its run, you really want signs that a broader part of the market starts participating on the upside. And if that does not happen, I think 7980 or 8,000, where a lot of call writing has already happened, is a level that we might not get past. In fact, we should be looking for a deeper correction in the market, maybe even a major top or at least a deep correction before we go up again because of all of these reasons. And like I said, we are mimicking 2007 last quarter. The reason is that the market continued to move up and down for several months. And eventually volumes dried up. We've already seen volumes dry up in the last month. And we also saw a lot of the call buying that happened in the initial part of the rally get cut back. We've also seen that in the month of August, that the heavy call buying that was happening in May, June and July has actually cut back this month and to almost a neutral position.
Rohit, there's a saying, right? Yeah, worry is, I don't know if I remember it correctly, worry is the interest paid before it actually comes due. Something like that, right? I think I got it broadly right. Or rather, you get my point. The rally in the US markets from 1,000 on the S&P has been, right? I mean, people have been calling for a top for a long time. It's been described by many people as the most hated rally in Wall Street, but the S&P is now 2,000 plus. I agree with all your points. But the fact is, when you look at charts and technicals, you basically look at what prices are telling you and what they want to do. That's essentially the basics, right? So why try and preempt a big correction, a big top?
That's a fair point. You probably don't want to preempt, but you at least want to be aware of it. There are two levels of trade. One is that if you're an investor and you are willing to exit 20% lower, and that's fine. You want to wait for that big sell-off to start before you really exit. That's one thing to do. The second is that you're a trader, and you can't really wait that long, because if your positions are leveraged, then you need to be out of the market the moment you see risk, and you can always re-enter, so you have the ability to enter and exit at any point of time. So these are two completely separate sets of classes that we address. Even for investors, when I say that, okay, fine, you want to hold on, but then what are you buying? Are you buying cyclicals? Are you buying public sector banks? Are you betting on the economy? So what exactly are you betting on? And then if you're betting on the global trends, then you need to watch out on what is happening at a global level as well. So the best performers of the last year would essentially be, like I said, in autos, financial, in technology, in pharmaceuticals, and essentially companies that have had a global exposure. If you say take even Larsen, 40% of its book is external. If you take telco, it's because of its exposure outside the country, and the same goes with pharmaceuticals. So that's been the bet. And whatever little bet took place on the economy is almost given up in terms of, if you just look across stocks, whether they are power, realty, banks, public sector banks especially, capital goods, all of them have given up. So these trends are pretty apparent. Now, would you want to have been in those sectors? So I would have consistently advised that, no, don't invest in any of these sectors, because it doesn't really look like happening. So from an investment perspective, that was not the right place to be. So that's how the theme breaks up sectorally. So now if you're a trader, there are opportunities on the sell side. For example, if I just looked at the index and I didn't short the public sector banks, would I have really made anything on the index? The answer is no, because the weakest performers have actually fallen a lot. Whether it's metal stocks, power stocks, all of them have taken a beating. You could have been short on those particular sectors and done better than simply trade the index. So these are different angles to the same market.
Do you sense that overall, right, when you look at it's more so in the US, not here in India, but the trader is the same animal everywhere, right? Wants to cut losses, ride gains, and prices have actually gone up quite a bit over the last couple of years globally, right? Global markets, US markets, for example, new highs.
Yeah.
Do you think there's a general level of complacency, and people have kind of sort of internalized the belief that central banks and the US Fed in particular will itself, or in the event of a big crisis, will act as a lender of last resort, whatever you want to call it, essentially would limit losses for the private sector, financial market participants? Do you think people have kind of internalized that when they look at markets, trading? I'm talking about the big traders, the big banks.
No, I don't think it's exactly like that, but definitely there are two schools of thought. There are those who believe that even though they are tapering, that at some point of time, moment growth slows down, there will be QE 4, 5, and 6. And that's a very small group of people. But on the other hand, if you just look at the size of expansion that has happened, I think they would really want to correct that, because how do you manage such a big balance sheet? It's something that nobody really understands, and everyone wants to actually see what happens at that point, rather than try to predict what's going to happen if so and so takes place. If there is a big crisis, if there's a liquidity squeeze, will they start pumping liquidity again? It's a big question mark. I don't know how it will function. One thing that I can see is that a lot of the central banks seem to be working in some kind of an alternate coordination. What I mean by that is, first you had...
Fair enough. So the ECB is talking about
exactly.
whether more needs to be done, Fed is tightening, Japan saying, well,
we'll print more.
Confused whether we've done enough, right?
That's right.
So but that's fine. But the point still remains, so you're saying that you're ruling out QE 5, 6, 7 infinity, right? You're saying, well, this is it. It's not possible. Even if they want to, more is not possible. The course is essentially higher rates and tightening the balance sheet.
No, I'm not ruling it out, but I'm just saying that they will wait for a crisis, and when the crisis arrives, whether the same medicine will work again is something we don't know. So just take for example that tapering is complete and interest rates start going up. At what point of time are they going to respond? And by that point of time, if people in the bond market have panicked, to the point where large portfolios are just unwinding and saying we don't want to be in the bond markets anymore. And like you said, is there complacency? Yes, there is complacency, and it's essentially in the bond markets, because a lot of money which has gotten allocated has gone into junk bonds as far as the US, because this search for yield because of the low interest rates in the US has led money to many other places than US bonds itself. So the differential between junk bonds, which are essentially low rated bonds, the difference between that and high rated bonds is the narrowest in the record of all data, you know. So it's never been this narrow, which means people are paying high quality prices for low quality paper. You know, so that's where complacency is there. So when that unwinds, will complacency go back into that market, and how much of bond buying is going to be needed at that point of time, and is it only going to be needed in government bonds because those will be considered secure? Maybe a lot of money will get allocated there anyway. The problem really will not be in the high rated bonds. The problem will really occur in the low rated bonds.
Rohit, you know, interestingly, as far as the US is concerned, the other day we were talking to Jim Rogers, and he was saying that he's going to start shorting junk bonds because he expects them to crash very quickly.
I think you were talking about Jim Rogers, right? Sorry, the audio dipped here.
Oh, all right. I was talking about Jim Rogers, and we were talking to him the other day, Rohit, and he was saying that he's thinking of shorting junk bonds in the US. And he expects them to start crashing, and that's where he's expected to make the money. So he's not really thinking of going long or short on government bonds or even plain that market, but just short junk bonds. Do you think that that's going to happen?
Yes. Yes, that would be the bigger trade. But the only thing is, in all these macro trades, you need to have time on your side. The US has a lot of instruments that allow you to do that, like ETFs and, you know, double ETFs or so on. There are a lot of instruments, and you can take long-dated options and take a bigger view on something. But if you're trying to time it, you know, that it will happen tomorrow morning, it might take 3 months, you know, before it actually starts playing out. That's similar to what we've seen in US equities. When we look at sentiment data, we say that we find that, you know, 90% of the people are almost bullish on US equities. And the Dow has barely moved up a few percentage points in 6 months. But it's still not selling off. You get a sell-off of 4-5% and then it bounces back. So the exact point of time where it will happen might be difficult. But yes, the big trade, like you said, junk bonds is where the maximum complacency is right now, and probably that's where the big trade would be.
Earlier you were telling Prashant that you're a little apprehensive that what you're seeing on the Indian markets reminds you of the last quarter of 2007, where some of the big cap counters were rotating, pushing up the headline indices, and the others were not participating. But if I look at a parallel at that time from the US markets, were the US markets also up at that time? Weren't they already starting to unravel a little bit? The yen carry trade had unraveled. The the subprime issues had already come to the fore. Is there a divergence there?
Yes, there are divergences at an intermarket level. The US market topped in October of 2007. The Indian stock market paused, similar to what we did in May. In October itself, but continued to make those higher tops of 100 to 100 points each time, all the way into January. You know, so it would sell off, then it would make another new 100-point high, sell off, then make another 100-point high. That continued till January, even though the US market was falling during that period of time. Right now, we are doing the same thing. If I remember correctly,
from February 2008, we had started seeing corrections in the US markets. February 2007, we had started when the first sign came of the yen carry trade unwinding. That was the first time we saw a significant correction. There were talk about bears coming back, but that doesn't seem to be happening at all in the global markets.
No, you had bear turns, which caused the first reaction, and then they bailed it out. And then that caused a new high in the US market in October of 2007, and that was the highest point. So that sell-off, you can say, is similar to the sell-offs we've seen. We've seen a sell-off just in June and July. The US market was down pretty well, especially on the Dow. And it's retraced most of that and made a new high just yesterday. So you can correlate that, but we're still not there where you see the bigger sell-off and say, yes, this is exactly the same. You know, so you've not gotten there yet.
But do you think that this time, actually, if we speak to anyone and everyone until the recent highs, you know, when the correction took place from 78.41 to 75.40, and even though the markets Nifty was retracing some of that correction, till it hit a new high, almost everyone said that they're expecting deeper corrections. And some of them lost conviction midway through after the new high was printed. But this time, the sentiment differential seems to be that Indian markets are much more pessimistic. You don't see that on the numbers, but from analysts and people we speak to, they're much more pessimistic than what is happening globally.
Yeah, well, it's possible because of the news flow, and a lot of us are tracking the same behavioral patterns. One of the other things which has happened, where you can say there's a difference between 2008, is the same kind of euphoria that we saw in terms of retail participation in these markets has not really happened. And those who are actually bullish a little longer term believe that this market will continue higher simply because that participation has not come. Until it happens, you cannot get a major top. So that's an alternate line of thinking. But having seen at least 4 bull and bear markets since 1991, I can tell you this much, that the lack of that participation itself is not a good sign. And every time you have a bull market, stocks, the market as a whole, that is the broad market, usually runs up in a frenzy, and that again seems to be missing. So many stocks that have sold off in the last 2 months are giving an indication that we are not really getting that frenzy. Stocks are not able to hold up, and money is going back into defensive sectors, which is exactly what you do not expect in a bull market.
Would it be fair to say that people made a lot of money in that 2005 to 2008 period, and then lost equally heavy amounts of money, the retail participants, and they're probably a little shy right now, right? Once bitten, twice shy. They're not going to come in that soon till they actually see a correction and a move up again.
That's right. You're going to need confidence, and with the confidence, there are 2 ways. One is, of course, the market goes up and confidence comes back, but I think something more, if you ask me, something more needs to be done as far as confidence is concerned, because all the way from 1992 onwards, we've again and again seen the market being hit by scandals, scams, and it's happened all over again. And that causes a lot of loss of confidence among investors, especially. Traders continue to come in and do what they enjoy doing, but investors as such feel dissuaded by this kind of action, and you really want something to be done to bring confidence back to investors to start putting their money in again. For example, you take one metric. If you go back to 1991, you'll find that the savings to equity, that is the amount of money going into equities from savings, was in double digits, almost coming to 20%. Today, it's not even 2-3%. So that despite a bull market and an all-time high in the market, the amount of money that people actually allocate to equities is very, very small. And that has to really change. And for that, you need some significant confidence building.
Right, Rohit. Thanks so much for joining us today.
We're going to take a break on, and I'd just like to say one thing. Warren Buffett, a couple of times in his various speeches to students, etc., always mentions this one book, which he says is a very bad book, but the title is great. The title is "You Only Need to Get Rich Once." I think it's a very strong, compelling argument, right? And I think that's what people try to do, but the point is very few succeed, right? They make the wealth, but then.
I think he also mentioned one more book which Pawan sir has arranged right in front of me, Prashant. You'll see that in the long shot if we show you. He's actually arranged it right here for me, and that is Benjamin Graham. It makes me look a little bit more erudite, Prashant.